We are mere hours from a Fed decision, and the S&P 500 gold are still trading near record highs. What are the market expectations? What should we be bracing for? And what is the data going into it? Of course, we can't affect any of that, or it can't affect the Fed decision that'll be hitting us here in a few short minutes or in a few hours. But we need to figure out, like, what's the macro trend? A 25 basis point cut won't change the trend at all, and we need to dissect that. What is happening with the dollar? What's happening in the bond market? Unemployment data, inflation. How is that all put together? And how should we as investors sort of react to all of it? How should we position until the end of the year? I've invited Keith McCullough. He's the founder of Hedgeye, and I'm really looking forward to this discussion for the next 30 minutes here. Before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously, and I much appreciate it. Thank you so much for doing that. Now, Keith, it is great to welcome you back on the show. It's good to see you again.
Yeah, good to see you, Kai.
Yeah, Keith, I said it. We're mere 3 hours away from a Fed decision here, but I don't think it changes. Whatever the Fed is saying really changes the underlying trends. Things we're looking at, unemployment, inflation data, actually quite conflicting data when you look at it from a Fed's perspective. What is your read on the situation right now?
Well, generally speaking, I mean, the bond market's front running the Fed. I mean, people like to overhype, the Fed's impact, but and say things like "don't fight the Fed." I mean, I don't fight the Fed. We front run the Fed, and the bond market is our best way to do that. Bond market and currency market really are two primary signals for that. So, ever since we started getting what we call Quad 3 growth slowing U.S. labor data, you've seen essentially our dollar signal break to lower lows, U.S. dollar index I'm talking about, and my Fed front runner is essentially my 2-year Treasury signal. That's beyond where it was at the September of 2024 lows. So we're really at an interesting point. As you recall, last year in September they had a panic rate cut of 50 basis points, and bond yields actually went up on the cut. So there's a lot to think about. Like I'm sure, like you, I'm not going to change my entire asset allocation and portfolio and retirement account based on what Jay Powell thinks or says, because of course, from a future inflation's expectations perspective, or growth for that matter, the guy doesn't have a clue.
Very, very true. And back in September, I remember him saying that he regretted cutting so late. Do you think we'll get a similar statement in a few short hours here?
I mean, he's covering his ass. Let's just start with that. I mean, he's under absolute, what I call max political pressure here by both Pump and Besant to cut by 50 basis points. The market wants to do 25, or at least that's the pricing of it all. So if he actually goes to 50, Powell's going to look like he's completely politicized and capitulated. I don't think it's quite Arthur Burns style, like 1970s capitulation to Nixon, but we're getting close where, irrespective of what Powell thinks, in the future, you're going to be pretty close to a point in time. Don't forget where I call him Pump, but whatever, Trump replaces Powell with somebody who just tells you that they're going to cut interest rates, 500 or whatever, 200 basis points, 100 basis points at a clip, whatever they need to say to become the head of the Fed. So there's a lot of dynamics associated with those politics. What typically happens, though, to the bond market is that it will eventually go with the rates of change of both growth and inflation, because again, that's where the economic cycle is going, irrespective of the politics.
You use the term Quad 3 call, or Quad 3. Like, for people not familiar with the Hedgeye language, what do you mean by that, Keith? Can you elaborate on that?
Yeah, Quad 3 essentially means stagflation. It means inflation. In this case, inflation's reaccelerating. That's just an empirical fact. Whether or not people at the Fed or otherwise Fed fanboys want to call it inflation falling towards the target, that horse has left the barn. I mean, we're up at pushing close to 3% headline inflation, and our nowcast actually has it going above 3% in the fourth quarter. We're at like 3.2% for headline CPI. So it's going the wrong way. That's inflation accelerating while real growth, in particular labor data, is slowing. Now, we don't think that that's going to continue to happen in every single month. Like, we actually think that the economy is going to accelerate on a real basis alongside inflation in the fourth quarter. So then you really won't have any reason for rate cuts. At that point, if you're actually looking at the two legs of the policy stool that they purport to care on. Of course, they care on a lot more than that, including what the president says and what the S&P 500 is doing.
Would you say that the Fed is maybe focusing too much on the unemployment data and maybe the bond market to a degree as well instead of inflation data? Should we be more worried about inflation ticking much higher?
Yeah, it's like this joke of a stool, right? I mean, you got a three-legged stool. Where's the S&P? Where's the stock market? Where's labor? And where's inflation? And for a long time, everyone's talking about inflation all of the time. And now all they want to do is talk about the slowing labor data while inflation's going back up. I mean, it obviously, from an objective or an apolitical perspective, makes no sense because there's no process in that. If you're saying that you have a dual mandate, then you should be at a bare minimum, equally weighing, the risks and balances of inflation and employment growth. But that's what it is. I mean, you have a lot of actually squirrely data that came through even on the labor side. There was some fraud in some of the Texas jobless claims numbers. I think that the labor data is as bad as it can get right now. And that's what we call quad 3 stagflation. So if the labor data were to improve, and I just mean sequentially from bad to less bad, and inflation continues to where we have it tracking, which is back, like I said, back towards 3.2%. Again, the Fed's not in a spot to be able to ignore that, and if they do, they'll be they'll be who we thought they were, right? It's like Dennis Green; they are who we thought they were. They're completely and completely and always politicized.
Like, how bad is the unemployment market really? Looking at it, 4.3%. If you would have shown me that 5 years ago, I've said, hey, that's great. Excellent employment data, almost full employment here. Why is everybody so nervous and panicking? Is it just about the trend, or are we missing something here?
Well, 50% of people hate Trump, and they're politically incentivized to say that the labor market is crashing and collapsing into a recession. I mean, you watch some of these yo-yo economists like Wolfers or whatever, like somebody who's just like blatantly partisan, when they're telling you that we're in a recession, labor's in a recession. I mean, of course, that's an absurdity, right? I mean, GDP, we have tracking close to 3% on a quarter-over-quarter basis. Retail sales were just reported up 5%. I mean, you have to cut the retail sales number, number in the growth rate in half, like 3 times to get towards a recession. So, we don't have a recession. The labor market, to your point, if you just look at the level, I'm not a big fan of the levels, but if the question is there a recession in the labor market? Of course it's not. And I'm not trying to, say that in the K-shaped economy that America has built under both administrations, because they're both degenerate money printers and, of course, fiscal deficit spenders. I'm not saying that a lot of people aren't losing in this type of economy, but those of us that are long of asset price inflation, and that's the most obvious inflation you could see, right? I always say to people, oh, you don't see inflation reaccelerating. You must not have like a trading account. You must not have a retirement account because it's going vertical. That's inflating. So if you're long asset price inflation, you're in a good spot. If you're in the part of America, which unfortunately 50% of Americans are, where you have no savings and your cost of living is going back up and the Fed's telling you inflation's under control, well, you're pissed off. And that's where you get a lot of this political, I'd say even anger associated with it.
No, absolutely. Like a bit of almost an understatement, I would say, because there's a lot of confusion about the employment data in particular. We're getting all these massive revisions as well, and yet, like we almost lost 1 million jobs, and I said it in another interview yesterday or the day before. But the unemployment data is still at 4.3%. We lose 1 million jobs, yet the percentage doesn't change. What do you make of that? Like, what do you make of the data itself?
Well, Bessent was very clever in really picking a fight with the BLS or the Bureau of Labor Statistics. Like, it's bullshit. The data's been bullshit for a long time. It constantly gets revised, in completely the opposite direction that in this case, the Biden administration was speaking towards, like the health of the labor market. And that's what the Biden administration, don't forget, boring their brains out to hire, people with taxpayer dollars. There was a third of said hiring over that period, irrespective of the revisions to the downside, had to do with government jobs, right? So there's so much bullshit in the labor data that it's hard to call it anything else, right? I think that what politicians are going to do, in particular, this administration and the Fed, folding their tent, so to speak, to them, is lean on the bullshit data. I mean, it's going to be what it's going to be. But if you look at anything in particular in small business, you're seeing resurgence in small business confidence. You're seeing a lot of positive things that you should see if we're right. And we think the U.S. economy is about to start to reaccelerate from here, from October until let's say at least till the second quarter of next year. And that's where the labor data is going to accelerate in rate of change terms. You're still going to have a relatively low, by all historical measures, unemployment rate.
For lack of alternatives, like we do have to trust official data, because I'm not going around from house to house and asking questions every day. Okay, it's just not possible. Like I try to read the news and I'm trying to make sense of it, but yet again, I'm not a data collector, and I don't run my own data, and I don't have thousands of employees to help me collect it. How do we establish trust again? Like how do we figure out what is actually real and what isn't, Keith?
Well,
Like, how do you do it?
Part of why the data was fake was because they were asking. There's this huge lag on respondents versus the actual answers, and they were asking people by fax. Like, who the hell uses a fax or a rotary phone at this point, right? I mean, so it's like a dinosaur. What I do think is that, I mean, if we have a lot of analysts, software engineers, data scientists, et cetera, and we have a lot more power, like with AI right now, to find different time series of data, whether they be labor data, inflation data, et cetera, et cetera. And you can, there's plenty that the machine can do for you to track this data. And I think the bond market's very much in tune with that. So we had a slowdown in the labor data that probably is as bad as it could get in the month of September. And on everything that we track on leading indicators, that should reaccelerate positively in October. If it doesn't, we'll say so, and we'll just go with that because, again, we're data dependent.
Let's talk about the bond market. You used the 2-year as a treasury signal here as well, and we've had guests on that said, well, the Fed funds rate should be where the 2-year is right now, roughly 3.5% in terms of yield. Like, what do you make of that statement, and should the Fed cut almost 100 basis points to get to that level?
I'd probably make about as much of it as if my fourth grader asked me if the cow should jump over the moon. I mean, I don't care. I mean, think about the things people on Wall Street get paid to say. I mean, well, I think that it should be right at the target. I mean, okay, it's just not. It's irrelevant. I mean, it's not the way the world works. When we try to answer these questions, people, what they should really do is start to look at the world the way that the world is. The world, much like a fractal pattern that explains the contour of an ocean line or the edges of a leaf, and economies, they're living, breathing organisms that are constantly in flux. It's a complex system. There are plenty of factors that affect it. If man comes and says, look, I want to bend and smooth the contour of that ocean line with this super secret equation that's like really not that smart about where the Fed funds rate should be relative to this rate and that rate, you're going to screw it up. That's what history tells you. We're looking for man-made solutions to some man-made problems, to an absolute natural order of things that doesn't care. Like, so to me, I just do what bond yields are doing. I do what the currency market's doing. I do what my signals are doing, is what I mean by that. And it saves me from having to think about all these things that people get paid. God help us all. But I mean, some people are paying for all these newsletters for these thoughts and ideas on the way the world could and should be. I don't waste my time on that.
Oh, it must be nice to take emotion out of it, eh? It's so difficult. Everybody's got opinions, of course, and in this day and age, everybody's very happy to share them, regardless of format, right?
Well, people are very happy to get paid for them too, right? I mean, and if you're willing to pay for somebody's opinion, that doesn't mean that it's going to pay out in your accounts, right? I mean, like I'm a big P&L guy because unlike a lot of newsletter people, I timestamp every position and people can see them every day. So I don't have the luxury of just opining for money. If you want that, you can go on Fox or MSNBC. I guess.
Absolutely, and I haven't been invited yet, so that's probably says a lot. But Keith, you've been mentioning.
It appears that you and I aren't wearing the right outfits for those shows, right?
Probably. T-shirts aren't really en vogue there, so
no,
I don't know.
I think Joe Rogan would like our style a little bit, or as my teenage daughter would say, they'd like your style.
Style.
You got good style.
Your style slaps. Isn't that something? That was horrible. That was embarrassing almost. That was absolutely ridiculous. No. Keith, back on topic. We talked bond market here real quick, but you also touched on the dollar, sort of giving away where things are headed. The Dixie seemed to be breaking down. We're now at 96 something. I forgot, 96.5 or something as we speak here, trending lower. What do you make of that trend in the dollar versus the other currencies now?
Well, when I look at markets, I don't believe that people can bend and smooth gravity. As I said, I don't think that policymakers can do that. Obviously, I believe in mean reversion. Like I believe in things like going back to the prior lows, revisiting those lows, making higher all-time highs in gold's case. those two things actually, when you look at the DXY or the US dollar index against gold, are one and the same thing. If you go back 180 days on the correlation, you can go to 90 days and it's a little less obvious, but on a trending basis, like 3 months or more is how we define a trend at Hedgeye. The inverse correlation between the US dollar index and gold is 95%. So 95% of the time they're doing the opposite, right? So what does that mean? I mean, one, you've already blown through the July lows for the US dollar index. Again, the dollar started going down after the stock market crashed this year. A lot of people forget that. I mean, we had that call that the market was going to crash and then recover without a recession. It's just a totally different way to look at it. That's why I have so many friends out there that love us for calling that, but not really. But it was a hard one for people to swallow because they're like, okay, market crashes, Fed go dovish. They got to devalue the dollar because both Republicans and Democrats, that's all they know. It's the only playbook they have. And that's what they did. So you've seen the dollar start to go down, 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 down. Now it's, since really February, and now it's violating those lower lows and gold's ripping to all-time highs. So, in a way, like it's the perverse relationship that you and I have with asset prices, in particular for as long as much physical and paper gold that I have, or gold mining stocks for that matter, is that I actually need the Federal Reserve to continue to fuck it up, like absolutely burn the purchasing power of the American people for me to keep getting paid, these epic, there's no other way. You and I have been doing this for a long time. I've been trading gold for 25 years. I've never realized these notional gains in gold ever. And I actually need the government to keep screwing up for that to continue.
No, 100%. I've been saying it, and we track financing data in the mining space as well here at Soar Financial. And one thing we've noticed, the second the Fed started raising rates back in March and in May 2022, the wallets just went shut, and that was it. The financing window closed, and now it's wide open. It is wide open, and the sector is doing phenomenally well. So we're closely tied to the hip. That's why, we look at this Fed meeting, and I mentioned to you before hitting the record button, I might be overhyping this announcement here that's going to hit us in a couple of hours. Am I putting too much emphasis on it, perhaps, in the grand scheme of things, Keith?
It's in this society. How could we not? We're human, and we're on a live wire here. So of course you're going to talk about the thing that's, what I call these are macro tourist events, right? Every Tom, Dick, and Harry and their dog and their hairy cat has an opinion on this. Like you said, you just let them talk. They have no models, they have no signals, they have no track record, but they'll tell you that this is a big deal, right? And it is a big deal. Ask Pump, it's a super tremendously big deal, and he wants a big and tremendously big cut. I mean, there's so many reasons why there's so many eyes on that, but that doesn't mean that the market moves have to be dramatic, right? And what you see is actually into all these macro tourist events, when it comes, here's another perverse reality of the stock market, is that, which we're long, we're long Qs. We're not going to be long boring SPY. Qs are much better. We're long the Russell 2000, which is even better than that in the last 3 months. But what happens into all these macro tourist events, whether they be CPI days, Fed meetings, NVIDIA earnings, is that due to the if you want to get into the weeds on this market structure of the U.S. equity options market, there is an epic level of hedging, panic put buying the day or the 2 days before the event. And that, as we like to say, that hedged pot doesn't boil. So what happens is you get the event, it's a nothingness in terms of end of the world, like a lot of people are trying to protect against. And then the market just rips new highs up again because you have to unwind all the hedges. So that's why we're making a lot of money in long stocks and gold. And it's been, quite a thing to watch. I mean, it's one of those things, like you're watching it, I can't believe it's still happening, but it's happening at a faster rate.
It's like a coiled spring. Absolutely. I've been having discussions with a colleague here of mine, and he made me ultra nervous because he's buying puts left, right, and center yesterday going into this, right? And maybe I think he actually follows you. So,
well, I mean, I wasn't buying puts into the event. It's like people, this is it's an amazing thing. Like what you want to know is who is buying puts on the S&P 500 in the middle of February, right? Okay. Who is still long gold in both periods, quad 3 stagflation now, and a quad 4 crash. Quad 4 is when, don't forget that inflation went down for those 3 months. And people screw that up too. They're like, well, I hope that the Fed's right and we get towards our target on inflation. If inflation goes down, the assets you own are going to disinflate, okay? There's so much to be taught to people. What I love is the participation, though. I don't want to hand out participation trophies, but I love that more people are participating than ever before, have opinions, have positions, because, we want to play against that.
Yeah, no, absolutely. Like the question is now, like, what is priced in this market right now? I'm looking at the S&P at 6,600, gold at close to 36 or 3,700 almost. Like, what are we pricing in? It almost feels like a bit of a redundant question here, or like rhetorical almost. But what's possible? It feels like we're way ahead of ourselves. Is that a realistic assumption, or like is there much more to come?
No, that's not an inhumane feeling when the Nasdaq makes 9 straight all-time highs. I mean, which hasn't happened in 2 years. It's not an inhumane feeling when the S&P hasn't had more than a 2% decline in over 100 trading days. I mean, this is what people start to think and feel because it's natural, right? Now, the better question for me, at least in my own mind, isn't just about my feelings about that, because they're pretty obvious. They're in your account too if you're long them, which is the other thing. Some people just don't like that because they didn't participate, which is a whole other kettle of fish. But what I really think it's signaling is that no matter where we have market corrections to, it's signaling the USA is not having a recession. Okay, the U.S. labor data is about to bottom. The U.S. economy is about to accelerate, and what you could easily have is bond yields going up. Our gains in gold start to correct a little bit, and stocks start going up for the right reasons, which is growth is reaccelerating. So, that to me, it would not be inconsistent with history. That would be first of all, that's what's in our nowcasts, as we call them, for both GDP and inflation. So we'll have to see.
Yeah, I'm always worried, like, are we getting caught off guard? Like, I'm looking at the GDXJ or the GDX, which is at all-time highs, and if I look at the RSI, it's massively overbought, of course. The question is now, is this time different? A lot of investors I spoke to the last few days, they're really worried that this is already, the top, and whatever the Fed says might, cause a massive rug pull here. Are you worried in that regard as well? If you look at the mining stocks, let's get a bit more granular.
I mean, I always say, like, picking bottoms is a very stinky business. Picking tops is even tougher than that. In terms of my own life struggle, I don't want to really entertain those types of things. But I mean, tops are processes, not points. Like, let's start with that. I mean, if you want to see a topping process in gold or gold miners, then show me a bottoming process in the dollar and bond yields. I mean, it's very straightforward. I mean, what's been surprising to me is that people are buying protection too early. So again, I've screwed this up more than anybody listening to this can screw it up, and publicly so. I have over 8,000 timestamp positions going back to when I started Hedgeye in 2008. So if you want to look it up, you can see it. But what I do is I learn from these lessons. So again, it's not enough to just say, wow, this can't continue, especially if you're using like old wall technical things like RSIs. I mean, that's not what my fractal signaling process uses. I mean, if it worked, I would use it. All right. I mean, instead of building something that works better. So if something is signaling higher all-time highs like gold is, and bond yields are still signaling lower lows, then you would have thought that these things could continue, right? And that's until they don't. Then I don't wake up in the morning saying anything else. I don't tell the gold price what it should or could do. I do what the signal is saying it's doing, right? And currently, the top end of my range for gold is up at 37.15. We got close to it yesterday. It's not to say that you can't get close, right? And for those of you that got married, look, you got to the finish line, you got married. Well done. You never thought it could happen. There you go. Things happen in your life, right? Gold gets to the top end of your range. I mean, you thought that Keith McCullough could never get married, right? Well, somebody was. Somebody bought into enough to do that. I mean, anything can happen, right, Guy?
Yeah. What was the over/under on that happening, by the way?
If you ask my hockey buddies, it was a surprise. All right.
Okay. Fantastic. Oh, that's hilarious. Keith, we're running through topics here, but let's try zooming out a little bit. We're having the U.S. and China meet in Madrid right now, discussing trade deals and just trying to kiss and make up. Although China seems to be playing hard to get. First, I saw germanium exports being halted yet again, despite discussions rare earths are being shipped again. And now just today, the Financial Times reported that China put a ban on purchasing AI chips from NVIDIA. Another clear signal. Like, what do you make of that, and how is that impacting markets?
I mean, I think the Chinese, if you're Chinese, are behaving the way that you expect somebody in their own self-interest should behave. I think what a lot of Americans in particular screw up, because it's generally, and it's easier for you and I to say this out loud, because I'm Canadian. But it's a uniquely American problem to think that the rest of the world is just going to bend a knee to whatever you or your new king thinks that you should do, right? I mean, the Chinese, like, are you kidding me? Like, you think a bunch of communists running the place are going to like just bend over? I mean, no, they're going to play hardball, and that's what they're doing. But in the end, like if you read a book that just came out, like Apple in China, which I think is a phenomenal book that really gives you a much more a finer appreciation for the complexity of the relationship, the coexistence that the Chinese and the Americans need to have, at particular the executive suite level from Apple to the Chinese Communist Party, just to use the biggest example. I think that they're going to play hardball on both sides of the political mics, but they're going to be playing a game of acquiescence, inside. And that's what's happening. I mean, I'm long Chinese stocks, and they've been freaking awesome, man. You think U.S. stocks have gone up a lot? I mean, Chinese stocks have been a lot better. And I think it's because you're going to see you're going to see an improve. You couldn't get from a worse place from in rate of change than where we were 6 months ago on China-USA from a trade negotiation perspective, or a rhetorical perspective, or a positioning perspective. Most people that I know, institutional or individual family office investors, they're way underweight China or have no position at all.
I was looking at Chinese stocks for change today, actually. Like Baidu was up 10%, and what else was I looking at? Alibaba, massive moves. I first thought it was maybe because they were expecting a tariff deal or something with the U.S., but it also has to do with Chinese stimulus. They're stimulating the economy domestically, trying to drive more consumption. Actually, one of the demands the U.S. had. What do you make of that stimulus package? How do we put that into economic context?
You had a big consumption stimulus package. The Chinese are going to stimulate. You know that. I mean, that's what a communist is going to do when they're in an economic slowdown. And you also have a huge delta, like rate of change improvement on the TikTok negotiations. So you get like all this like happier talk, less negative doom and gloom talk. And that it continues. I mean, the Chinese stock market's up 4.9% in the last month. It was up again last night, despite the U.S. having or at least having a small down day yesterday. So it's on its own path. I think the Chinese, like I said at the outset, I mean, they're going to do the Chinese are going to do what's best for the Chinese. Like, don't wake up in America thinking that other people in this world need to bend a knee to what you and or your president want them to do.
No, very, very true. And we're also biased by Western media, so we get filtered content over here as well. And I have to invite guests over that are based in Hong Kong from time to time just to get an understanding of what's actually happening on the ground. So just to get an unbiased view. But Keith, moving forward, and maybe until the end of the year, what should investors do now based on your models? What's Quad 3 telling you? Should we still keep buying gold, silver, platinum, or should we look at some other asset classes maybe to make up for potential loss of traction?
I mean, we're pleasantly long gold, silver, and platinum. Those things, I think the best of their relative gains is likely behind us as we enter October in the fourth quarter, because we're going from Quad 3 to Quad 2. The most important thing that we've been telling clients is that the quad count, Kai, is Quad 3, 2, 1. Really easy to remember, just count it down. Quad 3 in Q3, Quad 2 in Q4, and then Goldilocks Quad 1 to start 2026. So in that environment, gold, silver, and platinum would quite like going back to Quad 1. The one quad it doesn't like as much on a relative basis is Quad 2. Why? Because bond yields start to go up again. So that, and the dollar in this case, might stop going down. So that's what I'm on the lookout for. Unfortunately, I do have to deal with the Fed meeting today on that score, because it could change some of the railway tracks that our signals are on. If not, we just stay the course on the tracks that we've been on, which have been, this, like I said, this is, as this is the best run I've had being long gold since 2011. That was like a long time ago. Like, I had a different color hair. I had a different number of kids. I stayed married the whole time, by the way. She stayed with me the whole time. Whether gold was going up or down. But but yes, I did get married. No, I'm not married to gold. Like I like to tell people, they're just tickers. And you should expect, especially if we hit the top end of my range on gold and we publish it every day, and you start to see it make lower lower highs in the risk range, that would be the first signal that that this epic, unprecedented rally in gold, really, you should remember that. The best of it is behind us. And if it's not, then I'll just say that tomorrow. It's not. Looks like today it wasn't.
No, fair enough. And that's why you put out daily newsletters. Absolutely. Yeah. Keith, really enjoyed this conversation. I could chat with you for hours. Really enjoyed this. It was really, love the back and forth. Where can we send our audience if they don't know already?
It's hedgeye.com. And we also launched hedgeyeassetmanagement.com. So that's hedgeyeam.com. So you can check out our new ETFs on that front.
Fantastic. Awesome. No, really we'll do. We'll put all the links down below as well. Keith, tremendously appreciate your time. Thanks so much for joining us. And everybody else, thanks so much for tuning in to Soar Financially. Much appreciate you watching. How are you positioned coming in and out of this Fed meeting? Did you take some bets off the table or bet some investments, whatever you want to call them, speculations? I'm not sure what you call yourselves these days, but investor, speculator, there is a clear difference according to Rick Rule and to many others, of course, as well. So let us know down below. And thanks so much for tuning in. If you haven't done so, hit that subscribe and like button, and we much appreciate it. Thank you so much. We'll be back with lots more. Take care out there.